This session is really important. What I want to get to the bottom of here a little bit is the fact that, I think we're all in this area because we want to do things differently. We want things to be better. And I think, from what I know of everybody in this room, I think we're all good people who are trying to change things. So this is all about really positive stock selection, positive impacts and outcomes, reflecting what clients actually want from this area. And in doing so, what do you look for, what do you avoid, and what should advisors be looking out for? When we talk a lot about greenwash, but specifically, what things should people be looking for? So with that, I'm going to ask everyone to please introduce themselves. George, I'll start with you, please. Should be on.
Is that on? Yep. Hi, I'm George Latham. I'm managing partner at Web Asset Management. Web is a boutique investment management house. We only have one investment strategy, which is to invest in listed equities on a global basis, where we invest only in companies where their product or service is a solution to a sustainability challenge.
I'm Harriet Parker. I make stock recommendations for Liontrust Sustainable Investment Team. I've been there for 19 years or so, and I also coordinate the team's engagement with companies. So Liontrust runs about a third of the company's total assets under management. The Sustainable Investment Team runs a third of the assets. And we've got a range of funds across equities, fixed income, and managed strategies. And broadly, we invest, we integrate ESG in kind of three broad ways. That's through our sustainable investment themes, so that's making things cleaner, healthier, safer. But we also integrate it through our stock selection process and sustainability analysis. So that's kind of what the company does, as well as how well it manages it. And lastly, we're active owners. So we engage with companies on areas like climate and worker well-being, for instance. And we vote, obviously, for where we think companies need to do much better. So, board gender diversity, for example.
Thank you. Alice?
Is this on? Yeah. Alice Evans. I'm a responsible investment strategist at Columbia Threadneedle Investments. And we're a large mainstream asset manager with a broad range of responsible, sustainable, impact-related strategies across a range of asset classes. So we don't have any one single framework. My personal background is in equities, managing sustainable global equities. George gave me my first job in this space in 937 BC. So but since joining Columbia Threadneedle, my focus has been on specifically how we approach social issues in investment and stewardship, and bringing some more kind of depth and rigor to that after various bits of institutionalization of the approach to climate change across this industry. And one thing I've really enjoyed is getting into our social bond fund franchise, and I found it really exciting to see how well the bond market lends itself to achieving impact. And sorry, Julia, I have to call you out on this yet again. It is not just stock selection.
Oh, you're right, and I told you to say that. So,
so as we get into the discussion,
get
into the discussion, I'm going to try and bring that bond perspective as well.
And bonds, they're so interesting, and I'm completely aware. And thank you, and you'll probably have to pull me up on it again in 5 minutes. Just saying. And Kai, so you're the person who had to step in with absolutely point blank notice of this, and I do hope, because Kate is unwell. We've had so many people who are unwell, and the last couple of days saying, I'm sorry, I'm sick. But so Kai, thank you for stepping in.
Yeah, there's definitely something going around at the moment.
There is.
Yeah, so Kai Johns, I'm a senior ethical, sustainable, and impact researcher at Greenbank. So we're the sustainability-focused arm of Rathbones Group, the UK wealth and asset manager. So I'm very much on the company research side. I spend some time in the equity research team as well, trying to sort of bridge that link between the two teams as best I can. And very much my focus is on climate issues, so engaging with companies on climate.
Thank you. George, I'm going to start with you, if I may. In fact, no, my notes said Harriet, but anyway, let's start with both of you. Preferably not exactly the same time. It's getting late in the day. George, I've mentioned your name, so I will start with you. Look, a lot of the time, so bonds are different, right? But when we talk about equities in particular, does it really matter where we invest? So, come on, secondary markets. Does it really matter?
Well, I'll give you that sort of high level, and then we can sort of drill down a bit more. But I think the starting point is that we're concerned with systems here, and I think a lot of this conversation gets very reductionist. We want to be able to see visible line of sight cause and effect. But we're concerned with systems. We're concerned with the climate system, which is breaking down. We're concerned with the world's natural capital system and the biosphere, which are all systems. We live within an economic system, and we all work within the financial system. None of the economic system and none of the natural capital system, none of the world's natural systems work without the other parts of them working in tandem with each other. So we need all parts. We sit in a value chain, and listed equities sit in the ownership part of that value chain that owns and manages the ownership of companies which produce goods and services which ultimately get used. We do talk about impact because we invest in companies that have a positive impact. So we talk about impact, I think, has two dimensions, and indeed, actually, the FCA's consultation paper is arranged along these lines. That we talk about the companies that we invest in. We look for companies that have a lockstep relationship between their unit sales growth. So every time they sell another product or service, the use of that product or service has a positive impact on society or the environment, whether it's in terms of reducing carbon emissions, producing more renewable energy, in terms of managing water systems, or in social themes and along health, education, and the like. Those outputs are the impacts of the products of the companies that we invest in. Now, those companies are part of the whole financial system, the whole economic system, and that all needs all parts of that to coordinate to work in the right way. But we also look to have an impact as an investor. So we look at what we call our investor's contribution. That's the contribution we can make as investors within that. And that's partly by being intentional. We need to mean to do that. And so our whole business, Webb's whole business, is organized around a single mission, which is to advance sustainability and to create prosperity through positive impact investments. That's our whole being is around that, and we can do that by engaging with the companies that we own. We can do that by moving capital, shifting capital in one direction, and you do influence the cost of capital at the margin, but as part of a system, and also about directing policy and framing markets.
Thank you. Harriet.
Does it really matter? It's probably not a massive shock to you that, I think it does matter where we invest. I think, kind of put simply, you need to invest in the change that you want to see, like you've said. So otherwise, you're very unlikely to see it. Personally, I want to see change. We know that capitalism has done some great things. It's lifted a lot of people out of poverty. It's raised living standards. However, I think that that's been somewhat unequal in terms of how that's been felt across the global population, and it's come at an enormous environmental cost, disastrous cost, really. So we heard earlier that circular economy, and George, you were saying we're far from operating within our planetary boundaries. So we do need to do something. And so I think really the only way that we can do that is by investing, with impacts, this positive or sustainable, whatever kind of label you give it. That's the way that we're going to get a chance to really reverse some of the damage that we've done. And we're not going to get to net zero without really investors kind of shifting the way that they invest. So I think we've got this vision of where we need to get to. We do have the technology, it does exist, but it's this will and this intent really that's going to make the difference.
Thank you. And so Kai, can I come on to you quickly then? Just link to that though. Can we just engage our way out of this then? Is that the only answer, or does stock selection matter too? Maybe you could both pick up on that.
Yeah, for a start, stock selection very, very does matter based on the answers we've just heard. But in terms of engaging your way out of issues, I think, when we're in secondary markets, engagement is a key lever for change, but it's not a silver bullet. And how we sort of approach it at Greenbank is, we've got a high bar for sustainability in the first place. So we're not really going to ESG laggards and trying to engage and improve there. So a lot of the ways that we can have impact through our engagement work is more on this sort of system level issues. And one of the ways you can sort of see it play out, I suppose, is, what sort of companies do you want to invest in? Companies that have a competitive advantage, that have market power. And so when we're engaging with them and we're talking about Scope 3 emissions upstream, sort of supply chain issues, they can sort of use some of that power to bring the value chain along. And so I think that's one of the ways that it can have impact. But, it's not the only answer. And I think at the end of the day, there are a lot of different voices in the room. We only have so many levers available to us. And so, as I said, I don't think it's a
So there are limitations.
There are limitations, but it is a very key part of how you can have positive impact.
Alice, would you like to add in on that? Engagement, obviously on bonds it's different, but there's still conversations to be had, right?
Yes, absolutely. So I think, obviously, as a bond investor, you don't have that voting power or the influence of owning the company, but you can be extremely influential because you're constantly being tapped up for new issuance. The actual kind of ongoing operating capital of the business is depending on constant refinancing in the bond market. And so you have really a high number of touch points where you are controlling the immediate release of primary capital. And you can also that gives you a great opportunity to influence, and you can also be very targeted in that issuance on use of proceeds, and be ring-fenced, set quite a high threshold for expectations in releasing that capital. I think, yeah, absolutely.
Any other comments on this side?
I think a key part of this, though, is about what kind of investors we are. And we talk about our investors, whether intentional about sustainability or not. But I think underlying that is, are we investors or are we traders? And if you're going to be an intentional, sustainable investor that wants to have a positive impact, you've got to be an investor, and you've got to act like an owner as opposed to a renter and a trader of shares. And that all speaks to timescales. And so this only really works in a longer-term time frame. Obviously, we can talk about time running out and all that, and things are getting more urgent. But if we're just, trading shares on a very short-term basis, you're not really interested in the underlying dynamics of what's happening.
And you can draw a dot between that and what the FCA was saying earlier on 80% of people wanting people to pay attention to this stuff.
Absolutely.
So there's good reasons for doing it,
Absolutely, right? Yeah, and you can draw a dot all the way back and beyond to John Kay's review of markets in the aftermath of the financial crisis in 2012, where he talked about the difference between genuine long-term investment, which is actually involved in how companies grow, how companies invest, and the impact that has on the economy around it, and then trading shares. And the unfortunate thing is that our financial markets, our financial system, has become increasingly short-term. And year on year, average holding periods have fallen, and the interest that investors have in actually long-term investment in the underlying in the companies that they're owning is falling as a result. But this room, this audience, this focus, this positive intention should be absolutely concerned with investment and owning, because that's what will be really important.
Thank you.
Yeah, and I think we tend to, just from experience, we tend to have kind of more influence when we have, a bigger stake in a smaller company. But it's about kind of if we're not asking the same things kind of year in, year out, and we're just holding something for a very short amount of time and then getting out, you don't see that. So yeah, echo what you were saying there.
I think that's so important. Maybe we can come on to a slightly different sort of what things do you look for? So positive, impactful companies, whether it's on the equity or the asset side. And Alice, I'll ask you to leave this hand, but if you're an advisor or a wealth manager and you're picking funds, either for a portfolio or directly for an individual, just maybe one or two funds, what should someone be looking for? And maybe what are the horrors as well? Just any thoughts on, do look at this, or please stay well away from that. Alice, would you like to lead?
What do you look for? Well, I think it could be, in some ways, intuitively obvious. You're looking for solution providers, as George mentioned earlier. But looking under the bonnet there, I think it's really important to have a very clear framework to describe what you're looking for, because there are so many nuances and complexities and offsets to that question, compromises you might have to make. So I think a very clear framework has to be your starting point, for what you're doing and the decisions you're making and how you communicate that to your clients and to advisors. And I think, first of all, you have to be clear what are the problems you're solving for. And that can be a very wide range of social and environmental issues, or it could be more defined. In the social bond fund, we have 7 social themes, things like affordable housing, health and welfare, access to services, this kind of thing. And I think being clear what the problems are you're solving for is a helpful starting point, where you have to make some difficult decisions later on, where one thing might balance out another to some extent. And then I think you have to look at intentionality is a word that keeps coming up. We need to look at what's the intentionality of solving that problem in the investment that you're making. Is it kind of peripheral and coincidental, or are they really going to go at it? Is that an issue that's really being targeted? Are you going to get the impact you're looking for? And then I think also another parameter we use is kind of intensity of impact. We try and assess how significant is the level of need of the population being targeted by the investment, what's the additionality of what you're bringing to it as an investor, and also I think it's important to look at what's the quality of reporting on that impact that you're going to be able to get out of the situation. Are you going to be able to understand whether or not that impact is actually being felt in the targeted population? All of these are kind of parameters you need to kind of unpick, I think.
Can I pause for 2 seconds and just ask if anyone wants to put any red cards up with any of that terminology? Any red cards? Anyone not understanding? No, we're all good, are we? Okay, so additionality, intentionality. I don't know if you want to explain any of that any further, but maybe some of the other speakers can pick up on it. But that's all absolutely spot on. Yeah, George, yeah.
I think the point that Alice sort of emphasises there is that this is research oriented. This requires a lot of research to go through. It's not something that you can do with a simple screen, and themes can be really misused because they can be used like a kind of taxonomy of tagging, but really you need to dig a long way beneath that, because you can get, as Alice suggested, that there are different dimensions of impact, and you're trying to compare things across different themes, different end markets. And I like that concept of the intensity of positive impact. We use that as well, and it's about trying to understand, is this a small step or is it a giant leap? And both can be good things, but you need to understand it in context and contextualized. And it requires deep, fundamental, primary research to go and do that. So this is not a simple activity. Absolutely. It is very involved. Yeah,
I'm sorry, I wasn't trying to stop you there. I was just checking we've got people with us, but we obviously did, which is great. Alice, was there anything else that you wanted to finish? I've broken your train of thought. I'm so sorry.
No, that's fine. I could talk all day, but I will give, others can chip in.
You and me both. Okay.
Yeah, I'd just like to chip in on the framework point, because I think that's key. And the benefits of having the themes. I mean, you said you've got 7, we've got 8 at Greenbank. It's quite a common thing now. And the benefits of having those themes is that you can define within each of the categories your theory of change. So when you're talking about what positive things do you look for, you then have to try and work out how is this company meeting one of those 8 theories of change. And so you do need evidence. Desk-based research can take that far, but you do need the companies to provide some of that as well. So I think that's the key point really for me with themes and using them properly.
Thank you. And maybe Harriet, perhaps you could touch on that and then move into things that scare you when you see them, possibly.
Yeah, no, I think when it comes to those themes, some of them are really obvious, kind of like renewable energy, it's clearly a positive impact, but then actually it's how the company is really kind of managing its operations. So looking at whether, how they're sourcing their resources and whether that's done responsibly. There's a lot of detail that comes with it. It's not just what the company does, it is how it's doing it. And sorry, Julie, you were wanting me to go on to something else.
Yes, so things that you might see that companies put out that you just go, you should not use. I think it was, I know exactly who it was, but one of the speakers said to me on one of the practice calls, so you don't want us to say this has been our DNA for 50 years. Yes, that's sort of a thing that would worry me from a fund manager, but how about yourself, a lot of fund managers?
Yeah,
how
I think
companies
that is a very overused phrase, and I think when we see a big kind of thick sustainability report and it's in there, it's always a little bit of a red flag. But actually, it's not a problem. True. It's really not a problem if it's backed up by hard data and performance, and that it's when it's kind of full of lots of lovely pictures and kind of glossiness and very whimsical goals without anything kind of really tied to that. That's the thing that I guess scares us quite a bit. And if there isn't that desire to set those near-term measurable targets that we can see whether companies are really on the right trajectory, then that's definitely something that scares us. But I guess another thing is like management meetings. They're a wonderful kind of hunting ground, I guess, for some of those red flags. That's when you can really kind of tell the the story from the facts, and that whether the stuff in that sustainability report is something that senior management really believe in and really value.
Does it matter who they roll out? I was going to come on to that.
Yeah, I think it does. And I mean, I've been in some meetings where they, a new company that maybe don't invest in hasn't really done their research on who we are and is kind of poo-pooing a lot of the stuff that I'm asking about. So, I think to make sure that that's coming from the top, as well as having kind of well-resourced teams that are doing that work operationally, is definitely something that we look for. And
And I think one thing is making absolutely sure you know what's actually happening in the company, as you say, and there's lots of indicators and ways of getting at that. The other is making your own decision about where you're going to draw your lines, which is not always straightforward. And I think that's where you do really need your framework that you're going to stick to. And so an example I sometimes use is airports, and many SRI-related investors will recoil from the idea of investing in airports. And of course, the environmental issues are very well known and discussed. But if your focus is, your priority focus is on social themes, airports provide connectivity and support economic activity, and some bonds, like we've invested in the Schiphol green bond, where it's saying airports, we're taking that for what it is. It's not great, but that's not what we're focusing on.
But
and
some
we're
people
looking
will want them, right? Some clients will be comfortable.
Oh yeah, absolutely. I'm just saying this is where you need to be clear where you're drawing your lines, and what they're doing with that green bond really met our criteria when we went through the detail of our investment analysis.
Cool. Thank you. Kai?
Yeah, in my sort of last answer, I was talking about the positives of thematic approaches. But I think one of the red flags that might come out of that is if you're looking at a company, say a renewable infrastructure company, where the positives are really clear in the energy side, but the company's not treating sustainability as this interwoven nature, and therefore this sort of human rights aspect of where you're building and how you're interacting with local indigenous groups, etc., aren't coming into play. I think not thinking about the broader picture is a red flag for me.
Which is one of the problems that we've got with the term ESG, because people think they're all three silos, and actually
Exactly.
no, it's all completely interconnected, and it's one of the issues we've got there. Anything else on that? I'll be open for questions. Or did anyone else want to comment on any red flags that we've missed, or anything that you'd like to say? Or maybe let's see if we can get the mics moving again, and if there are any questions on this kind of impact, and maybe anything red flag contentious stuff that you guys don't like that you see in literature, or that you question, that maybe you've seen that's been conveyed that's worried you. Is there anything anyone would like to comment on that at all? And it's getting late in the day. One lady in the middle, towards the right here. Charlotte, just through there.
You've spoken in detail about how you identify, great companies on, say, sustainability grounds, and, they have really good products and services. But obviously, there's also the financial analysis of a company, and really good sustainable companies can still perform poorly for long periods. So I was just wondering how your sustainability analysis links with the financial analysis, and where how this brings together the sell discipline, and when you say, this is not the right time to invest in this company. I'm talking more about situations here, not when you're selecting it for the first time, but when perhaps you've already held a stock for a while, but certain external circumstances or whatever are changing the short or medium term prospects for that company, even though the sustainability researchers are still very impressed with it.
So the financial plus impact dynamic. George, please.
The word integration, if I use that, might get a red card banded around by someone. It's a word that gets massively overused and inappropriately used sometimes. But ultimately, what we're looking for, because we're only looking at businesses where their product is solving a sustainability challenge, but we're really looking for that sustainability story, the reason why that product is growing, that market is growing, to be the core of the investment story. So we're looking, we look for positive impact markets or positive impact enterprises to be a source of growth. So we're looking for companies which are exposed to growing markets because their product is providing the solutions that we need to see in the world. So the starting point for us is that is the source of long-term market opportunity for a business. that focuses on what the company sells. ESG for us is about how the company is managed. And we're not interested in ESG for its own sake, but we're interested in looking at the way that a company addresses its environmental, social, and governance challenges, because we're looking for evidence of quality. We want to invest in high-quality businesses which are operating in growth markets, because those growth markets are growing because they're creating positive impact. And then the third dimension, or the third gate, if you like, that you need to go through is then what are you paying for that? If you're paying for high-quality companies operating in fast-growth markets, and then you're paying a massive premium for it, then you're still in a position where you ultimately may lose money. So it's ultimately you need to get the right balance of those things. We'd love the most positive impact company that's the highest quality at the cheapest valuation, but that's not always available. So there are judgment calls to be made in that, and that's where the analytical framework comes in to try and get the best combination we can. But the impact is at the front of the gate.
Yeah, absolutely, and I'd add a couple of things to that. One is, I think, you are naturally looking at long-term investments, and I think you tend to find higher quality companies where they're managing these issues most effectively. And I think it's important not to be a little bit distracted by a company that doesn't seem that cheap, but it's well valued for what it is, but you can compound those returns over time by buying a business with resilience and with those long-term growth prospects. But the other thing I would say is I think unless you're really in a kind of the philanthropic end of the market, we're all investing for market level competitive financial returns, and that's the sustainability story is never going to trump that, really. And even though it sometimes breaks our heart, like we recently turned down an Orsted blue bond that was ticking all of our sustainability boxes like absolute crazy. They've done a wonderful job, but the financial side just didn't make sense at that time. And you just have to have the discipline to let those things go as well.
Yeah, I mean, similarly to, it's the four parts of our process is the themes, they're first, which I've talked about, and then the sustainability analysis is second. But the third is business fundamentals. We're looking for high returning businesses ultimately, and then the fourth one is valuation. But I guess where we kind of, and if it hasn't got those four, then it's not in the portfolio. And to your question is, what happens if there's a company that's actually been held in the funds for quite a long time, or at what point do you kind of sell, or do you reduce your position? And so that's where it's critical. Actually, it's business fundamentals sometimes are the ones that we like to review more often, because that can be kind of something that the detriment to the investment process, to the investment case for it. But when we tie this all together, it's through engagement, actually, because when we speak to companies, we can understand how aligned they are with that theme. We can understand if there's any improvements, maybe in the sustainability analysis or otherwise. But also that's where we get to understand those business fundamentals that kind of will lead us into understanding that valuation. And there's been, a number of times where actually I'm talking to a company about their carbon strategy, and I'm saying, well, hang on, I can see there's going to be margin improvement here. So I'm talking to the CFO. At what point will you need to kind of declare that there will be a margin improvement from this? So I guess it's about getting some kind of information advantage to how these things work in practice, and how that company is perhaps more undervalued than the market might anticipate.
Yeah, I was just going to add to this. I suppose when you talk about the impact and the sustainability story being aligned with the investment case, the flip side is true. So if the company starts to struggle, then it's not delivering as many products, it's not delivering that positive impact, and so the impact case is also affected by the weak fundamentals. And I suppose one of the problems we have in this industry, especially in the sort of smaller and mid-cap space, is a lot of companies that are fulfilling a sustainability demand can be quite sensitive to fiscal stimulus and regulation, and so you either need to watch that carefully, or try and find those companies that can stand on their own sort of 2 feet, if you will.
Hello, good afternoon. I'm sorry it's a bit late, and I think all of us need a bit of coffee, so I'll try to pose a question which may require longer discussion. My name is Shabir Razvi from International Finance Solutions Associates in London. One of the challenges that I face as an advisor to many of my clients in the Middle East, North Africa, and that part of the region is they understand part of the ESG, environment, sustainability, but the governance issue is really a challenge for them to really evaluate. They feel that so-called positive impact is very Eurocentric. How do we combat that? That's one question. And secondly, obviously, in America, as you know, the presidential candidate, Mr. Vivek, is now talking about woke capitalism. So is it woke capitalism, or my Middle Eastern clients say that ESG stands for extremely sinister game?
It's a great question. It's a really difficult question to answer but I think the issue is really about whether you focus on culture or outputs. And I think the trouble is a lot of the frameworks that we try to manage to, because it makes it simpler to communicate, means that we end up with frameworks for outputs, which means we slightly sort of tick boxes, and that's a real challenge. And I think a lot of the way that sometimes the diversity, equity, inclusion approach has been, or issues have been addressed, is about trying to create frameworks of what it should look like in terms of outcomes, whereas actually it's much more important to look at culture and how culture is then supporting what will then eventually become the right outcomes that we seek. I don't know if that's really an answer for you, because that involves needing to understand the culture within a company or within a manager, and that is a subjective judgment as of itself. Is that helpful?
So can I make one more suggestion, which is that our morning keynote, and we've got the afternoon keynote coming up soon, but from the FCA, was saying they've put out a consultation on this recently. So you should reply to it, right? And do bring in the international dimension, because we're talking about investors here, right? Which, none of us really care what country stuff happens in. We care what happens in the country, but we can invest anywhere between us. So yeah, being aware of cultural differences in different areas is massively important. But we did actually kind of cover that in an earlier session, but thank you for it anyway. Can I just ask, we've only got 5 minutes left really, if I can just ask you to maybe all give examples of the kind of things that are seen as being really positively impactful, and also the kinds of companies that you would invest in because they're positive, but also from an individual retail client's perspective, they're going to be seen as pretty borderline, or they might say, oh, that's greenwash. I mean, obviously, people have said, well, Alston have still got some oil and gas, but, for example, so I don't, who would like to lead on that? Kai, would you like to?
Yeah, I think the borderline example is probably quite an
more
interesting one to take. So the retail client point as well is interesting, because within Greenbank, you have many different clients, each of whom is able to set their own ethical preferences differently. So what's borderline for one might not be for another. But just to take a company that I was looking at recently that I thought had quite a complex and nuanced sustainability story was Boliden. So it's a Nordic miner and smelter, copper, nickel, all things that are very much needed for the energy transition. Now, that smelter side as well is quite useful to it, because it then can take sort of recycled goods. It can put it's the largest e-waste recycler in the world. So you've got a sort of clear positive aspect to it, but naturally it's a mining company, and so you have biodiversity issues, you have potential human rights issues, and to some extent that is addressed by its Nordic focused and sort of Irish focus. But nevertheless, it's a really complex one. And so for different retail clients, some might take the view that actually we need these metals, and so it's a sort of necessary risk to take on. And others might take the view that it's too much risk, and it's more than they can deal with personally.
Certainly my old fund, probably some of what Alice works on, mining was out.
Yeah,
but certainly at certain points in time. Anyone else want to comment on those borderline? We've got, let's say, 4 minutes, so we'll just maybe do a quick run through this. Alice, whoever.
Yeah, I mean, I'm happy to. I'm on the team. It's rarely kind of black or white. There's very much kind of grey and lots of nuances, and so there's a constant set of trade-offs and kind of discussions on the team. But I think it does come back to being very clear about where those lines are, and I think that. For instance, knowing what the controversial companies in your funds are, managers should be able to explain them and with a good rationale. So, one of the ones in our portfolios and our global portfolios that always comes up is Alphabet or Google, we don't hold any of those other kind of so-called FANG stocks, but we do review it regularly, and I think that comes down to the majority of revenues from Alphabet come from advertising, and in our view we think that kind of really powers the core search part of Google's business, and it enables this access to information for all. If you think about it, advertisers pay quite well for wealthy demographics, and it's in some ways it's those demographics that are kind of subsidizing this indexed information for everyone. Alternatively, we could think that there would be a subscription to access this kind of information, and we think that would probably lead to kind of an information inequality and divide. So, on balance, there's other things we like about Alphabet. On the green side of things, they're great, but there's a whole load of things that we just don't like either. So it's a really hard one. But I think to be able to, a manager needs to be able to defend it ultimately as to where that sits.
Absolutely.
Yeah, it's that
Alice,
being able to defend it. It comes back yet again to you have to have a really clear framework about how you're looking at it and what you're prioritising. And I think I already gave the example of the Skupol green bond that we went for. On the other side of that, we were looking carefully at a sustainability bond issued by Mars, and the use of proceeds were being targeted very positively at greening and the supply chain and inclusion in the supply chain, very, very positive things that they were going to be doing. But in the end, the product is of really no social merit and conflicts with our theme of the health and welfare. And so in the end, no, even though these use of proceeds are really positive, we are not going to make that investment because the product conflicts with what we're trying to achieve. But there's so many trade-offs to be made all the time in this space.
George?
Yeah, I think it's really important in this space that there is transparency. And a lot of because we're investing in companies that are having a positive impact, it tends to mean that we're invested in mid-cap companies, which tends to mean that a lot of the names are not necessarily known to retail investors. They may not have heard of a lot of the companies that we've invested in. We publish every single holding in the portfolio, and we publish a one-pager that says why we own this stock, why it has a positive impact, how it comes through our research framework, what we're engaging with it in, how it links to the SDGs, so on and so forth. And so it's that level of transparency I think you need, and that's what's going to get demanded by the FCA in the new SDR. You need to provide your theory of change around each investment, and that will make it clear.
And I would add to that, that's where the logic for the surprise holdings bit came from in the SDR. Those conversations I was having with the FCA a long time ago, just saying good fund managers know exactly which ones of their stocks are going to be asked questions about, are going to worry clients. And you'd be amazed the amount of pushback, from what I understand, from people saying, that's just a ridiculous question. Why should anyone have to? How could anyone know what a client's going to be worried about? Well, if you talk to people like here, we all know what's going to upset our clients because we live and breathe this stuff. So that's something I really hope does come through in the SDR, but I don't know if it will or not. But time will tell. I know this gentleman at the front is very keen to ask another question, so super quickly because we are out of time now.
Final question. Thanks very much for the panel. Just with respect to the 3.1 trillion of pension assets we've got in the country, and just the idea of, I guess, the cognitive diversity of pension trustee boards. So the Pension and Lifetime Savings Association have talked about the fact that pension trustee boards, only that 25% are all male. The Institute of Financial Actuaries has talked about the ethnic representation on pension trustee boards at 3%. Gender representation, female representation, only being 12%. And the idea that we're sort of asking this group of stakeholders to make the decisions with respect to sustainable investing how proactively are asset owners engaging with you, aside from the bellwethers, the Brunels, the Scottish Widows, and like, how actively are asset owners engaging with you with respect to sustainable investing? Thanks.
Shall I just ask one person to lead on this if you can, or one or two maybe? George, go ahead.
I'm happy to. We've seen that there are so many different investor groups in terms of asset owners, from your pension funds through to retail investors and the like. They kind of seem to move like this. You kind of get different areas. We're definitely seeing, I think there's a huge opportunity in defined contribution pensions. And that is, the biggest problem, or one of the big problems in the defined contribution world is trying to get members to engage with what their pensions are. 97% of all defined contribution pensions end up in the default scheme. I think that this area is a platform on which we can increase engagement with members. The thing that we're finding in more of the DB area, the defined benefit area, where there are bigger pools of capital, is that this can be seen as an asset allocation decision. So this can become more strategic. And that is, I think, really interesting, is that people are investing or allocating to the impact economy because they see that as a defined exposure they want to take on a strategic basis. And so you've got different motivations in different markets, but it is coming.
Well, now just to maybe say a few final, is there any final thoughts or anything that you've missed that you'd like? Because I will close off the session, maybe just a sentence or two. Guy, please, if you'd like.
I'm not really sure in terms of final thoughts. I think we've done quite well in covering what I wanted to cover.
Cool. It's very nearly time for a cup of tea. Alice?
I think we've discussed a lot of the issues, haven't we?
Okay.
It is time for tea.
I'm just giving you all the opportunity in case anyone's got an itching issue that you'd like to cover at all.